Is trading just gambling? Many people think so, but what if I told you they're completely wrong? There's a world of difference between the two, and most people miss it entirely. Gambling is about luck, a game where the odds are rigged against you from the start. Trading, on the other hand, is a strategic play of probabilities, preparation, and discipline. Stay with me, and I'll reveal how trading works, why it's far from gambling, and how you can avoid the pitfalls that turn it into a gamble. Let's start with a simple example. When you flip a coin, there's a 50% chance it will land heads and 50% for tails. That's probability. Now imagine you could analyze the coin flip. What if you knew that when you flipped the coin under certain conditions, it landed heads 60% of the time? You'd have an edge. And that's exactly what trading is. A game of probabilities where you tilt the odds in your favor through research, analysis, and strategy. Take a stock pattern, for instance. Let's say you've studied a particular pattern, and over hundreds of trades, it's been profitable 65% of the time. Does that mean it will work every time? No. But over a large number of trades, the data shows that the odds are in your favor. This is what makes trading a game of skill, not chance. Gambling versus trading. So what's the difference between gambling and trading? Gambling is throwing money at something random, hoping for a lucky outcome. It's like walking into a casino, putting your chips on red at the roulette table, and praying the ball lands where you want it. You have no control, no system, and the house always has an edge. Trading, however, is all about preparation and probabilities. It's about studying the markets, understanding patterns, and using data to make informed decisions. It's like playing a game of poker, where a skilled player calculates their odds, manages their risk, and makes decisions based on probability, not luck. But here's the catch: trading can become gambling. How? When you trade without a plan, without research, and without understanding what you're doing. Buying a stock because you saw it trending on social media? That's gambling. Making a trade because you have a gut feeling? Gambling. Chasing a hot tip without doing your own analysis? You guessed it, gambling. The difference is clear. Gambling is acting on pure chance. Trading is making calculated decisions based on probability. The power of probabilities. Let me emphasize this point further. Trading is a game of probabilities. Imagine you've developed a system that wins 60% of the time. For every 10 trades, you might lose 4. But those 6 winning trades will not only cover your losses, but also leave you with a net profit, because you've tested your system and it works over the long run. That's the power of probability. Now compare that to gambling. In a casino, the odds are always against you. The house edge ensures that over time you'll lose more than you win. In trading, you create your edge by doing the work, studying the markets, analyzing data, and testing strategies. This edge is what separates successful traders from the rest. Risk management, the key to trading success. But let's address another point: risk. Every trade comes with risk. But risk in trading is not the same as gambling. In gambling, you can't manage your risk. The outcome is out of your hands. In trading, you control the risk. You decide how much money to invest in a trade, where to place your stop loss, and how to protect your capital. Risk management is the cornerstone of successful trading. Here's an analogy. Think of a professional poker player. They don't go all in on every hand. They manage their chips carefully, folding when the odds are against them and betting strategically when they have a strong hand. That's how a skilled trader operates. They don't bet the farm on one trade. They calculate the probabilities, manage their risk, and make consistent decisions. Why the stock market is not a casino. Let's talk about the stock market for a moment. This isn't a casino. It's a place where some of the smartest people in the world operate every day. Hedge fund managers, analysts, economists. They're not flipping coins or rolling dice. They're studying data, analyzing trends, and making informed decisions based on probability and risk management. Do you think they're gambling? Of course not. They're using systems and strategies to consistently stack the odds in their favor. And you can do the same, but only if you approach trading with the right mindset. When trading becomes gambling. So when does trading cross the line into gambling? It happens when you don't have a plan, when you're buying stocks randomly, chasing the latest hype, or trading based on emotions. That's gambling, and it's a recipe for disaster. For example, if you see a stock trending on social media and decide to buy it without doing any research, you're gambling. If you make a trade because you're angry about a previous loss, you're gambling. Successful traders don't operate this way. They stick to their systems, follow their plans, and keep their emotions in check. Building a system. The solution is simple. Build a system. A good trading system is based on research, data, and discipline. It tells you when to enter a trade, when to exit, and how much risk to take. It's not about being right every time, it's about being consistent over time. Even the best traders lose trades. But they win because their system is designed to produce profits over the long run. The final takeaway. Here's the bottom line. Trading is not gambling if you approach it the right way. It's a game of probabilities, where preparation and discipline determine your success. Gambling relies on luck. Trading relies on skill. If you have a system, manage your risk, and treat trading as a business, you're playing a calculated game, not rolling the dice. So, the next time someone says, trading is just gambling, ask them this. Do you flip a coin to make your trades, or do you calculate your moves? That's the difference. That's why trading done right is not gambling.